Markets correspondent here on the Schwab Network. George, we're watching Cinemark hit a new two-year high today. Excuse me, a little bit of a tongue twister there. So it got an upgrade. What are you seeing with this?
Well, actually, I see a stock that's improving its fundamentals. And if you mentioned the two-year high, it's hitting new 52-week highs. And, everyone's really focused on AMC because it's a meme stock and it's really popular with retail investors. AMC is owned about 80% are retail investors. But if you look at Cinemark, I mean, this is the third largest, theater chain in our country. And in fact, they actually have operations in Latin America in about 16 countries in Latin America and Mexico. And they operate in 42 states with over 5,800 theaters in our country or total globally. But I think overall, this is a company that's performing exceptionally well from the standpoint of improving its bottom line, even though if you look at its sales going all the way back to 2019, and I use these 5-year comparisons, but it does coincide with the pre-pandemic closure, but the company is actually generating about $200 million less in sales than it was 5 years ago, but it's actually generating about 3 times the profit in that particular year. So with those improvements and some anticipation in top line sales improvement going into 2025 with the release of a whole slew of new movies, there's been a lot of upgrades. MKM Roth was actually one most recent upgrade. They moved the target to $26 from $19, and they do increase their buy rating from a neutral because of the fact that the company seems to be executing from an operating leverage standpoint quite well. It's actually improved its free cash flow, I noticed, by 3 times compared to last year. So its free cash flow is growing, its net income is growing, but it's doing so, like I said, going back to 5 years ago, on additional equity, or in other words, shares in the free float only higher by about 2%. So, and this is a story of a company that's just performing exceptionally well. And this is why, again, institutions are the majority owners of the shares versus AMC, which I've talked about quite a bit on this show, is sort of in a catastrophic decline because it has a tremendous amount of debt, but it also is losing money. Whereas if you look at Cinemark, they're actually expected to earn about $1.74 going into next year. So it's only trading around 11 times that year's earnings.
It's wild to see that this is kind of like the perfect setup for overlooked stocks because I had not paid attention to Cinemark because so much attention is paid to the meme stocks, to AMC. And then when you kind of compare them, when you compare year to date where Cinemark is compared to AMC, it's like night and day. Is it all about the issue with leverage when it comes to Cinemark versus AMC?
It is. It's a function of leverage, which is really a balance sheet issue. AMC just has too much debt. I mean, they have about 3 to 3.5 times debt to equity. Now, Cinemark, they've got debt as well, but if you look at their market cap relative to debt, it's around 1.5 times, which is certainly more manageable. About $3.4 billion in debt, but they do have about $900 million in cash with free cash flow that's improving and growing. So that speaks to, more confidence, let's put it that way, in this particular name, if you are investing in the theater space versus an AMC, which those fundamentals are moving in the wrong direction. So unfortunately for AMC, they just have to dilute by issuing new equity, and that's essentially what we've seen, particularly last year with the stock down about 80 or so percent. It's been a massive dilution year because that's one way they're financing negative operating cash flow, whereas Cinemark is actually doing it endogenously. So hats off to the committee or the executives of that company. They actually seem to be improving their operations and they're being well rewarded.
Okay. And George, any final takeaways on that space on Cinemark versus AMC or just overall the direction for Cinemark?
Well, I think the overall trend for Cinemark is obviously higher, looking at the 1-year trend, hitting some new 52-week highs. But I will say this, on a secular basis, if you go back to 5 years, I mean, Cinemark is still down. So there are still some secular challenges. And what I mean by that is, movie theater, people going to the theaters has actually declined because of the fact that streaming has made it a little bit more efficient and maybe less cumbersome to go to the theater. And that's been eroding essentially the revenues for this whole group. So I think that's something to keep in mind. That's, I think, a risk that you have to consider that's still involved in this entire group.
All right, that makes sense. George Tsilis with insight on our overlooked stock of the day, Cinemark. Thank you, George.